Should we apply for a grant or claim R&D tax credits? This is honestly one of the most common questions we hear from finance directors across Ireland, and I completely understand why. Both options fund innovation, but they work in completely different ways. Today, I'm breaking down the key differences between R&D tax credits and grants, so you can figure out which one's right for your business or whether you should be using both. So let's start with R&D tax credits. These give you a 30% credit on your qualifying R&D expenditure, and that rate's actually increasing to 35% soon. Now, here's what surprises most people. The eligibility criteria are much broader than you think. You don't need to be inventing the next big breakthrough. If your team is solving technical problems where the solution isn't readily available or readily deducible by a competent professional in your field, that's likely qualifying R&D. The key thing about R&D tax credits, they're retrospective. You claim them after you've done the work and spent the money. Now, grants work completely differently. Grants give you upfront funding from organisations like Enterprise Ireland, IDA Ireland, or Horizon Europe. You get this money before you've spent it, which means you can undertake projects you might not otherwise afford. The amounts vary massively, from tens of thousands for early stage innovation to millions for cutting edge research. And beyond the money, many grant programs offer business coaching, networking, or specialist vouchers for things like AI adoption or climate action. But here's the catch. Grants are competitive. You're applying alongside other companies, and even excellent applications get rejected because funding is limited, and they typically come with strings attached. Also, large grant amounts go to genuinely cutting-edge projects. That incremental improvement to your production line, it probably qualifies for tax credits, but it won't secure major grant funding. So what are the main differences that you need to know? 1. Timing. Grants give you money upfront to fund your next steps. Tax credits reward you after you've already spent the money. 2. Certainty. Tax credits are an entitlement. If you qualify and you can evidence it, you'll get it. Grants are competitive. No guarantees. 3. Flexibility. Tax credits have no restrictions once you've claimed them. Grants come with reporting obligations and specific project requirements. And 4. Cash flow impact. For early stage companies burning through cash, grants can be transformational. But for established businesses with steady innovation, tax credits provide reliable, predictable funding year after year. Now, can you claim both? Yes, but you can't claim the same expenditure twice. If Enterprise Ireland gives you €50,000 for equipment and contractors, those specific costs can't also go into your R&D tax credit claim. But any expenditure not covered by the grant is still eligible for R&D tax credits. So which option is right for your company? You should consider grants if you're early stage and you need upfront capital, if your project aligns with specific grant criteria, and if you have the capacity to meet reporting requirements. For larger amounts, your project needs to be genuinely groundbreaking. You should consider R&D tax credits if you're an established company with a steady R&D activity and you need flexible, reliable funding without the application uncertainty. Honestly, most innovative Irish companies should be claiming tax credits as a baseline, then assess whether specific projects warrant grant applications on top of that. You can read more on our blog, linked in the description.